Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their estate planning and inheritance tax planning. So today's video is around a family investment company and why you would choose to set up a family investment company for an investment portfolio in order to save yourself significant amounts of money in inheritance tax. So why would you use a family investment company for an investment portfolio to save inheritance tax? So to understand the main benefits of family investment companies, you should go to our playlist on YouTube and watch the number of videos that we've got on that playlist. But there are two main reasons. Firstly, you want to manage your own investments, but you still want access to the capital and the income. This may be because you want to keep sufficient funds to make sure that if you ever need long-term care, you've got access to your capital and your income. Other reasons might be is that you may have significant assets well over £1 million and you may not live long enough to use only trusts to place money outside of your estate. So in scenario one, if you want access to the funds, most people are happy to use a flexible reversionary trust because that does allow you access to income and capital back over a period of 7 years. However, you must use in that scenario a pooled investment managed by a fund manager. So if you want to manage your own fund, then obviously a flexible reversionary trust will not do it for you, but a family investment company will. And it will allow you to do this as there are no fund restrictions. You can manage the fund and hold whatever assets you like. Okay, scenario two, your longevity. So you can only place £325,000 per person into a trust every 7 years without generating an immediate tax charge of 20% on any amount that you gift into a trust over that nil rate band allowance. So, for example, you place £525,000 into a trust, the extra £200,000 would attract an immediate 20% tax charge, so we've never done it. However, you can place money in every 7 years. So you can place £325,000 in straight away and then do the same again in 7 years' time. Now, you must bear in mind, you must live 7 years after the date of the last gift in order to avoid the IHT charge on that particular gift. So therefore, placing money into a trust past age 75 to 80 does carry a significant longevity risk. So this means that older people with a significant asset base may not live long enough and may not have a long enough life expectancy to use only trusts. So this is when an FIC may prove to be very useful. However, there are points you need to be careful about. So firstly, never mix an family investment company with a property family investment company. If necessary, have two family investment companies or at the very minimum, hold the property portfolio in a subsidiary company of the FIC which holds the main investment base. This is because if a tenant dies in one of your properties and you get sued, well, the most they can take is the value of the properties and they can't touch all the assets, the other assets. But if you mix everything into one company, you carry a significant risk of losing everything in that company. Okay, so when you set up an FIC with an investment portfolio, you need to be careful about the capital gains. Because although you can transfer an asset directly into a family investment company, it is deemed as a disposal for capital gains tax purposes, and therefore the capital gains tax is immediately payable. So a lot of the time people will surrender their investments and place cash into the family investment company. This has the added advantage of being the cash going into the company being seen as either a shareholder's loan or a director's loan. And therefore, as your investment portfolio produces a return over time, you can take that return out of the company for the rest of your life by repayment of those director's loans, completely free of all income tax. So since the director's loan or shareholder's loan is still in your estate, you shouldn't keep it past the age of 78, obviously earlier if your health isn't that good, because you need to give it away for it to be outside of your estate. Now you can give up that director's loan to your children and they will be able to withdraw the funds completely free of all income tax. So director's loans and shareholders' loans are a very sensible tax planning vehicle, especially if you're putting cash into a family investment company. All in all, family investment companies are a very useful vehicle for tax planning purposes for wealthy people to help them avoid inheritance tax. Hopefully you found that useful. If you did, give us a thumbs and a like, and we look forward to talking to you again. But thanks for listening and goodbye for now. Bye.